I think the US, like the rest of the world, is actually in quite dire straits. It's very modest growth with margin compression, full stop. And on the back of that, you don't really see a full-fledged economic recovery. So we see compression of the middle classes and their behavior to basically stimulate the activity. Now, the consequences of that is actually pressure on the US dollar. This falling US dollar right now, which you have, is the next indication that probably the next round of stimulus will be around the corner. I think if you look, the number today was not a big surprise. We had the Baltic Dry Index being released a little bit earlier, which was very, very weak. It actually almost collapsed. So we see that the external trade numbers will not be very, very strong. So we're looking at flattish, maybe even slightly down on export numbers in the short term, and probably for a 12 months period, flattish structure internationally. So you've got to ask yourself, where is Chinese growth coming from? And if you look at the political statements, they are very being clear. Let's look at infrastructure spending domestically, and let's look at the service economy. And that's where your growth is going to come from. But it's not going to be enough to have high growth number in China. So you look at very low and modest growth numbers, which might not be sufficient in an environment where you still have a credit crunch in the banking system in China. I think if you look beginning of the year, everybody's been selling India because of current account deficits. We are going now through an election process, and during this period the market will stay quite fragile still. But the current account deficit is still a major issue, and the current account issue is driven to a large extent on gold imports. You've seen some of the liberalization coming through on that again, so I think gold will make a big difference. Now, many countries will take the gold export out of the normal current account structure. If you take that out, then actually it doesn't look that bad, and you see a strengthening currency, which might result after the election in lowering of interest rates. So it's a very domestic market, not dependent that much on export, which might get an interest rate stimulus. And from that point of view, it's an isolated market. It's not as highly correlated to other markets. It's an attractive investment inside the emerging market basket.